Hey everyone, this is Bryce Gillen from Asha Capital Partners. I want to share a video with you on the current macro perspective of the market. This is my view on the market and how Asha is looking at the market. Possibly this video may have some educational opportunities as well, so I hope you enjoy it. As always, at the end of this video, if you have any questions, feel free to reach out to myself, email, call, or text. And then it's important to note this is not financial advice, simply our views on the market. For today's video, we will go over the following items. First is looking at the market phases. Second, we will look at Bitcoin, Dow Jones Industrial, and other historical charts, and then tie that practical to the theoretical market phases. We'll look at portfolio strategies and investment strategy rotation timing, seeing if there's ways to optimize your portfolio over these various market cycles. We'll look at the current macroeconomic factors and how we think those may be impacting the current cycle. Thanks for watching, and reach out if you have questions. A brief introduction to the four phases of a market before diving into the Bitcoin chart is accumulation. This is often the bottom of the market where prices stay at a decreased level for usually an extended period of time. Sometimes there's an example like COVID where it's what we call a V out, but that is an exception. It's more common to have this accumulation phase. The advancing phase, or what's often referred to as a bull market, followed by the distribution phase. This is where a lot of people who accumulated are now distributing and selling their shares or tokens or coins to try to lock in some of that profit. And then lastly, the declining phase, or the bear phase, where we currently are in the market at this moment. This is the Bitcoin price chart going back from 2012 and all the way to current right here. And what I want to show you is the past market phases and how they played out. And then also we are not currently, but we have dropped 63% from peak at its low, which it wicked down to at 26. Right now, we're about 55-60% down. It's hovering near mid 29s. So going back here to 2013 or 2012, 2013, you can see a big run up. So again, the incline phase after a drop down. This one had a very short drawdown period from peak. It was only 84 days. So you might even say that's an intercycle drawdown, followed by another extended bull run up there. So if you're looking at July 2012 to January 14, that's about 18 months almost of run up. That is an extended bull market timing. And then from here you can see 87% drawdown almost over 413 days. So just over a year and a few months to get the final end of the decline phase. And then we see here, again, an accumulation phase that's happening. So that's about January through October, November, arguably. So again, about 9 months in there, 10 months. And then we see run up. So if we go from November of 15 to December of 17, that's almost a 2-year run up. So that's a pretty long bull cycle in their incline phase. And then again, after that, you're not seeing an extensive period of distribution here. You can argue that some of this was distribution or some of this was distribution, but you're seeing what we call kind of an Eiffel Tower pattern, where it has a quick spike up and then a quick spike down. This bear cycle lasted 364 days, so just about a year. And then again, you have your accumulation phase at the bottom. This one was a little bit shorter, from December to April. So about 5 months there. And then again, you have a brief run up. This is a possibly kind of almost another accumulation phase, but really from here to here is kind of a bull market. You do have a COVID spike down, and so we talked about this earlier, but this is a little bit of a V out. And so you can see a quick rapid drop. Fed steps in, prints a lot of money. A lot of people have money to invest, and you have a quick jump up in price. And then that led to, again, what some people call the first peak. And we'll get into RSI a little bit. You can see the RSI peaks right here. RSI is a momentum indicator. It's called the Relative Strength Index, and it indicates the extent of price increase and the number of price increase days divided over price decrease days, and the extent of those. For the RSI indicators, an important thing is when they're overbought and when they're oversold. And again, 70 or above is considered overbought, 30 or below is considered oversold. So with this most recent bull cycle, we can see that the peak of the RSI, so when it was most overbought potentially, is January, and it was only at 35,000. But then it continued upwards And as it went upwards, actually, the RSI in general declined, coming down here to less overbought. And so by April, it was almost no longer overbought, and that's about when it peaked. So when RSI is dropping, but price is increasing, we call that bearish divergence. And that usually means the market is running on fumes, it's on its kind of last gasp, and so you might expect a downturn after that. And then you can even see the RSI still went lower in November when it actually peaked right near 70. So again, bearish divergence. Not always right, of course. Again, no indicators are foolproof. Everything has to be interpreted. The market is always changing and adapting, but it's something that can be looked at from a broad picture. And then again, you can see RSI here is quite low. You know, we're entering the low 30s. RSI at the end of the last bull dipped right below 30. RSI at the end of the previous, or at the end of the last bear market, at the previous end of the last bear market, again dipped below 30s. And look, it's really hard to tell. Again, it's just an indicator. Here it was at a bottom, you know, at completely oversold. But then, you know, that's at 270. Wouldn't you like to buy Bitcoin at 270? And then it went down to 156 from there. So, you know, that's another, what is that, like almost a 40% drawdown again from a near bottom to RSI. So a decent indicator to tell you when it's there, but you can never be certain. Looking at the Dow Jones Industrial chart, we see similar items. So I want to point out some of these. This chart goes back to the 1800s, always interesting. Here's that almost 3-year, 2.5-year, 46% downturn. And here is a 2-year, about almost 48% downturn. End of the 1920s, here's a 90% drawdown over 3 years, 53% drawdown over, what's that, 4.5, 5 years. And then, you know, didn't map all of the major drawdowns, but we see another 46% drawdown over a couple years. This one's real quick. You know, this is Black Monday, 42% drawdown. And then up here, we have the dot-com bust, only a 37% drawdown. I believe the NASDAQ drew down 83%. 06, 08 financial crisis, almost a year and a half, 2 years, and 54%. Most recently, COVID, real snap. You can see that again is the V out with a lot of Fed support, 38% drawdown. And then currently, right now, we've experienced up to a 17% drawdown over about 120 days. So if you think this is going to be another dramatic downturn, we have a lot of room to go down still. And again, looking at the RSI is still high up. Now, you know, again, it's just a semi-useful indicator. There's plenty of times the RSI has dipped to a medium or relatively low level and then bounced back up significantly. It could do that. I just point out this chart to say, hey, if you think we're in a major downturn, we have a lot of room to go down. And then another interesting point is we've never seen a bear market for the broad markets while Bitcoin is also in a bear market. Bitcoin was originally invented 2008, and so during the last financial crisis, and so it's never seen a downturn with a broad market. So that poses a little bit of extra concern for myself. And then if we're looking at QQQ from the NASDAQ, you know, this only started in 99, so we only have limited data here. But again, you see 83% downturn with the dot-com bust, and then 06, 08, 55% drawdown, much shorter time period. And then again, COVID was a quick drawdown and then a V out. And so we're seeing right now a down about 32% from peak to the recent trough. If we're going to go down, these are just, for example, 50%. Here's where you would see it. 70%. Here's where you would see it. The last major chart I want to show is this total cryptocurrency market cap. You can see it peaked at about 2.95. I can't quite get my mouse there, but that's 2.95 at the top. And then right now it's about 1.26, oscillates a little bit. So a big drop off, over 60%. But if you look back in time a little bit, you can see, you know, just a year ago is 1/4 of what it is now, or over a year and a half ago, 1/4 of what it is now. So again, a very disruptive technology, a lot of potential. I see a lot of long-term growth available for it, but you know, that's something that we're going to have to see play out over time. So again, over the last year and a half, you can see significant. This is a 2-year time period actually, but back here, significant increase from that. I would expect this to probably drop a little more, and then after that, get a bottom, get a nice accumulation phase before a future run occurs. The negative news about markets like this is that finding significant positive returns is very difficult. However, again, protection and preservation during times like these is the primary goal. I'd like to reiterate that Asha GPs are heavily invested side by side with our investors. We have skin in the game. It's with great responsibility and care that we manage our own money, but especially others' money, as it's with great trust that we were given this opportunity. The team takes great diligence in looking for opportunities and taking prudent risk management steps. We wouldn't do anything with this money that we wouldn't do with ourselves, and often we're even more cautious and careful with it. So, what do we see ahead for the opportunity for us, and what do we see as the strategy for us? As we presented before, we're looking at this as a very defensive positioning time. We've done this since the start of the portfolio. That's part of the reason that Asha's seen 1% returns from November through the end of April, whereas the market's dropped about 40%. So as we enter into these market conditions, we think about a few different things. One is the reduced volume, which means less activity from participants. This leads to reduced earnings on almost all kinds of strategies. The strategies I want to present right here and focus on are arbitrage and market making. These are some strategies that the funds that we're targeting right now we're looking for. We're also looking for long short. And so what we do is, just a high level kind of understanding, but optimal cycle timing for these events, bear market or sideways market. We're experiencing both of those over the past few months. And so arbitrage can provide some limited earnings opportunity if performed well. And then market making is the same. Long shorts can also provide this, though they also add significant volatility, especially if they're discretionarily managed. So right now, again, we're trying to allocate to arbitrage, market making, yield fund type strategies, and a little bit of long short, especially programmatic, as that usually performs better during times like these if it's designed well. Again, even with this, these strategies will see reduced returns. Everyone sees more returns during a bull market because the basis trade is higher, the futures are more differentiated from the current price, and there's just more volume and liquidity in the market. So these are tight times, and it appears they will get tighter, so we'll continue to position ourselves defensively. I also look for anecdotal information during different market cycles. I'm kind of chuckling because we've all seen it. You're driving around, or you have a taxi driver, Uber driver, and they're talking about recommending a coin to you or a stock to you, or a doorman's doing that, or a hairstylist, or your neighbor's talking about a hot crypto or stock. Okay, the market is probably overinflated. Are there memes or coins that are ridiculously named? Are companies changing their names to include blockchain or crypto? All of these things mean a market's probably overheated, and that's when it's time to start allocating to arbitrage or market making strategies, similar to if the market looks overheated from a technical perspective. I would say sometimes the indicators are just as good when they're anecdotal as not. You just have to mind your own emotions, and pay attention to them. Secondly, some questions that I like to ask when market conditions aren't so great is, are people asking about good investment ideas versus talking about how to be defensive? If they're talking about how to be defensive, well, they're not allocating money anywhere. That means money's not flowing into the market. That means money's most likely flowing out of the market, and that means we're most likely going to drop in price. So who's looking to make large investments right now? Is anyone looking to make large investments? And what is the timeline of those investments? And then who's looking at new and innovative ways to find opportunity? Most of these opportunities are coming from VCs right now, or people with large capital accessibility and very long time frames. Any VC investment right now, which you'll continue to see for a while in this space, won't have a payoff for several years, but that's a risk and opportunity that these people are willing to take. So the answers I'm seeing is everyone's scared. Most are seeing how to move their money into cash or how to be defensive. And we're looking to do some of that, but we're also looking to find where we can find yield. And then very strategically be prepared to when do we add back into our portfolio. If we're staying in cash and the price of Bitcoin is dropping and we think it might be at 20K that there's a bottom, are we going to wait until it goes all the way back up to 40K to buy back in? Or are we going to say, no, we got a really good deal around 20,000 and that's when we're going to start allocating? We're always going to watch the market conditions day to day and try to figure that out. But we know that when it has had significant price depreciation, that's when we will want to enter, because that is going to be more opportunistic than waiting for it to come back above the current price. If we're waiting for that opportunity, we might as well buy in right now, right? So again, that's how we're looking at it, trying to be defensive in this time frame and then move to more aggressive strategies when price shows some advantages to us. Another big question is, where are we now? What makes this time different? Is this time different? I think we always see a bull run and someone says, this time is different. See it Every single time. The housing market, oh, this time it's different. 2006, 2008. The tech market, oh, the internet's coming out. This time it's different. In general, the time is never that different. So how is this time different, and how is it the same as other downturns in this case? So what are we seeing? We're seeing a big debt bubble. We're seeing a Fed that can no longer prop up the economy. That's pretty large. Why? Because inflation is happening, and the only way they can fight it is to buy back the debt and increase the interest rate. So there's increasing interest rates. That's going to compress corporate returns, which in turn is going to lead to layoffs. I don't know if you guys have been watching the news, but that's just starting to happen. Tech firms are laying off people. If they're not laying off people, they're reducing hiring or freezing it. That could lead to and further cause issues for consumer debt. More debt's going to occur. People have had inflated wages in some cases over the past few years, or seen free money, and that's all going to end. And then there's others that are already in trouble, and that's going to be a problem. That will further a wealth gap that has been growing for years and exacerbate social issues. And there's already a global war that's affecting commodity availability and has no certain end. So there are a lot of current woes. In my mind, there are more current woes than typically, which could be for a bad little run for us. There's also some advantages. We still do have low unemployment. Layoffs may change that. And then the other thing is we have more cash on the sidelines than we've seen in a long time. So while the market is going down, there is plenty of firepower out there to stop it. So, who's going to catch the bottom? Will someone catch the bottom? How long will this run go down? When are people going to be too thirsty to invest and want to try to find some return somewhere? No one knows those answers. We do know it looks like it's going to be tough for some period of time, but we don't know where that bottom is and how we're going to get out of it. Thanks for listening to this video. I hope you learned something, or at least got a little more comfortable with how we're thinking about the market and looking at it. Again, I want to share that all investments have risks. No one is ever going to be right all the time. You can hope to be right a majority of the time and then use that to your advantage. I want to end the video by saying I don't believe in a losing scenario here. I believe there's opportunity out there, and with enough effort, thought, and tenacity, we can find it. Thanks again for listening, and if you have any questions, please reach out.